Is Pure Storage a buy or a sell? Let's get started with the model. This is a large cap company, 21 billion market cap. They're trading at $64 a share, and they have 327 million shares outstanding. Pure Storage is a provider of enterprise-grade all-flash block, file, and object storage. It was incorporated in 2009, headquartered in Santa Clara, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doubled from 21 to 22. That was its highest ever, 600 million. It came down 21% to 500 million in 2023, up 19% to 575 million in the trailing 12 months. Pretty good margins, between 14 and 22%. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 21, but positive after that. The highest in the trailing 12 months, 130 million. Revenue is the sales for the company, and that goes up each year from 2.2 billion to 3.1 billion. It's not a huge growth, but they're beating inflation. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows, past year 4, that's 28 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $25 billion. We divide that by 327 million shares. And we get a calculated stock price of $76. They're trading at $64, so they're trading at a 16% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 33 companies in the same industry as Pure Storage, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend almost 200 million in capex, which is more than the median average. Their debt to equity ratio is 0.2. That's between the median average. They don't pay a dividend. They generate 575 million of free cash flow, which is more than the average. They rank 8th in market cap, pretty close to Seagate and Supermicro. They're trading at 13 times book value, 160 times earnings, which is the highest on this list, 36 times free cash flow, which is worse than the median average, and 7 times revenue. They generate 3 billion of revenue, which is about half the average, but their revenue is growing. Their 5-year annual revenue growth rate is 15%, which is equal to the average. And the stock is trading at $64 a share, which is pretty close to its 52-week high. So it looks like you missed out on a lot of upside. If you put $10,000 into this company when they started trading in 2015, you'd be at $40,000 today. That's a 16% annual return. To summarize, I have them trading at a 16% discount, ranking 5 out of 10. I'm not too familiar with this company, so I couldn't say for sure if I would buy it short-term and long-term. It seems like they're doing well, they're profitable. I need to do a lot more due diligence. Ratios 3 out of 10. Ratios are much worse than median. Financials are pretty good. Free cash flow up 87% since 2021. Revenue up 41% in that same time frame. Let's take a look at their income statement. Here's the third quarter of 24, third quarter of 25. This column is the 3 months ending 10/31/2024. And this column is the 3 months ending 10/31/2023. Their fiscal year ends January 31st, so they're currently in their 2025 fiscal year. In 2.5 months in February, they'll be beginning their 2026 fiscal year. Revenue is up from 760 million to 830 million. Product revenue is up slightly, but subscription revenue is up a lot. Revenue in the US is up from 535 million to 562 million. Other countries, 227 million, currently 269 million. So you can see their product revenue is pretty much flat. It's not even up 1%. Subscriptions is up 22%, so overall revenue is up 9%. And they mentioned the growth in subscriptions is renewals of their Evergreen subscription services. It looks like their main subscriptions are Evergreen One, Evergreen Flex, and Cloud Block Store. The expenses for product is 150 million. Revenue 450 million, expenses 150 million. So pretty good margins. Subscriptions, 370 million of revenue, 93 million of expenses. That also has pretty good margins. I'm surprised their margins in product is this high. Cost of revenue 248 million, gross profit 580 million. That's up from $550 million. R&D $200 million, sales and marketing $255 million, G&A $67 million. So their total operating expenses $520 million, which is a lot higher than last year. It went up in all three categories. So their operating income is lower than last year. Last year $74 million, now $60 million, and they have higher revenue. So operating margins went down quite a bit. They pay $13 million in taxes, so net income $63 million. EPS of 19 cents, last year 22 cents, and they're adding shares. Last year 314 million shares outstanding, now 328 million. So net income is going down and shares are going up. Not the best formula. Let's look at a balance sheet. Current assets $2.6 billion, current liabilities $1.4 billion, so a pretty high current ratio. This column is as of 10/31/2024. They have about $1.7 billion of cash or marketable securities. So it looks like they're pretty well funded. Property and equipment, $430 million. Here's a breakdown of the PP&E. Most of it is test and infrastructure equipment, $436 million. Then you have computer equipment, $375 million. Leasehold improvements, $100 million. So it's about $1 billion total. They depreciated $550 million. So the book value is $430 million. Most of the PP&E is in the U.S., $418 million, $13 million outside the U.S. They have $360 million of goodwill, so it looks like they do plenty of acquisitions. Total assets $3.9 billion. Total liabilities $2.4 billion. They have a lot of deferred revenue. In the current section, $900 million. In the non-current section, $800 million. This is when a company receives payment for a product or service before it's provided. So they're sitting on this cash. When they do provide the product or service, then they'll remove the liability off the balance sheet and book the revenue onto the income statement. Assets minus liabilities equals equity, $1.4 billion of equity. They raised $2.8 billion from selling their business. They took in that money and burned half of it, so they lost $1.4 billion from running their business. That means they have $1.4 billion left over. And a lot of that $1.4 billion is cash. Let's look at the statement of cash flows. This is for the trailing 9 months. They have a lot of operating cash flow, $545 million. Last year it was $430 million. That's how much cash the company generates from running their day-to-day business. In their investing section, they have a cash outflow of $90 million. Most of that is from the purchase and sale of marketable securities. They spent $170 million on PP&E. Last year, $150 million. In their financing section, they received $21 million from the exercise of stock options. They received $52 million from their employees buying stock. They spent $140 million of taxes on their employee stock. That's a lot in taxes. And they bought back $182 million of their own stock. I'm surprised they bought back so much stock because they don't have that much additional cash flow to work with. Let's look at a company on Simply Wall Street. Its last price, 63, $22 billion market cap, up 1% in the past week, up 75% in the past year. They started trading in 2015, so a little over 9 years ago. It looks like it IPO'd around 18. It dropped about 50% over the first year. Then it ran up to 29 in 2018. It didn't do that much over 4 years. It just came down, then came back up. It's still pretty much traded sideways over the next couple of years. It was in the mid-30s in 2023. It did well from January of this year. It was in the mid-30s. It almost doubled in mid-2024, getting close to 70. Then a big drop back down to below 50. Then it ran back up again. So this stock is all over the place. Simply Wall Street's valuation is 51. They say the stock is 23% overvalued. 21 analysts priced this stock at 72. They say it's undervalued. They only had $40 million of revenue in 2014. Then just 4 years later in 2018, it hit $1 billion. And then it took 4 years to double to $2 billion in 2022. Now it's over $3 billion for the trailing 12 months. The CEO's salary in 2018 was only $222,000. Now it's $800,000. Total compensation $37 million. Tenure as CEO 7.3 years. Look at how many insiders are selling. Look how long this list is. Nobody's buying. It looks like about 900,000 shares were sold by insiders in the past year. 85% of the companies owned by institutions, 10% by the general public, and 5% by insiders. Fidelity is the biggest shareholder at 15%. Then you have BlackRock, Vanguard. Kaz, as they call him, is the founder. He owns 4% of the company. Then you have Disciplined Growth Investors, Nikko Asset Management, Norgus, Amundi, Polar Capital, And their employee count went up a ton from 800 to 5,600. And the ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and Sao Paulo Bolsa. So if you want to get a free discounted cash flow model, click on the video in the top right corner. Thanks for watching.